How is the business performing, and what are you doing to build resilience in what has been an otherwise pretty volatile time in the energy markets and, let's call it a downbeat quarter, Q3 for big oil?
Sure. Let me first take a step back, and the business overall is doing really well. Weatherford's in better shape than we've ever been before. This year we're on track to deliver record high EBITDA margins of 25% plus, going to generate about $500 million of free cash flow. Our leverage is in the best shape it's ever been. So we're in a really good shape, but clearly the macro has changed a little bit. Activity has started to drop. We've seen that moderation that we addressed on our earnings call very recently. What we're really doing is a couple of things. Number one, we're making sure that our focus on cost, our focus on cash, just continues to be at the highest degree of focus. This is really something that has been our North Star for the past few years, and so we're not going to let go of that. The second is making sure that we are right-sizing the company to take the right advantage of the situation we've got in front of us, and we're dealing with it head-on. The third is technology, making sure we're innovating and delivering solutions to our customers that add value so we can get the right pricing and therefore the right margins. And for me, the litmus test has actually been our North America business that has been in a bit of a downturn for the past 18 months. It's been coming down, and we've still managed to grow margins in that market.
You and I have spoken many, many times over the last few years about the transformation that's been underway at Weatherford and the efforts that you've been putting in place to right-size the business, to put it on the growth trajectory that it has been on. Just a question on the sustainability of the revenues that you're seeing. Will you be able to sustain this type of growth in coming quarters against this macroeconomic backdrop?
Yeah, so I think it's going to be a little bit different. We see activity moderating as we go into 2025. North America still sort of flattened down. The international markets are maybe up low single digits. So that's really a different market than what we've seen over the past few years with significant revenue growth. So what we are more focused on is margin expansion, and we believe we can still generate margin expansion. Our goal is to deliver between 25 to 75 basis points of margin expansion in a flat activity market. So that's what we're focused on. We think we can, we've got all of the levers to be able to deliver that.